Most retail traders don't conceptually understand how the market really works. Since this is a conceptual thing, what I'd like you to do is just listen and be open to some unusual thoughts. And just to establish a base to start from, I'm going to cover some things that you already know, then I'm going to point out some things that you probably never thought of before. Alright, to start off with, here we are. We've got the big wide world, and retail traders are over here trading all over the world, trading any combination of currencies they can possibly think of. But for all the retail traders to trade, they have to go through a market maker. They don't trade retail trader to retail trader. They trade retail trader to the market maker, who then goes to another retail trader. And these market makers, they aren't always as scrupulous as you'd like to think they are. There's a group of 12 very large international banks that have been colluding in a private chat room for over 10 years, where they were talking about how they had to take different currencies to different levels and bring them back down. The regulators finally caught on, and they fined them $6 billion. Banks are still out there doing fine. It shows how much money they took out of your account for not $6 billion not to hurt them. Then you've got the brokers, FXCM. They're front-running their customers or sending them off to a special bank that was going to give them kickbacks on the business. They got fined $7 million and told to leave the U.S., and they're still doing fine. Shows how much money they stole from you. That's the back-end stuff that you really couldn't see. Now the front-end stuff that you can see is like this. You, the retail buyer or seller, you're trying to buy something. You're going to buy it from the market maker at a price he's willing to sell it to you at. If you're selling it, you can only buy it from the broker, from the market maker, who's willing to sell it to you down here. So how do you deal with that? I mean, this is the spread. So this is legit. So how can you deal with that and the other ways that you may not and probably don't know of that they use to lighten your account? What do? So what we're going to do is we're going to take a slight tangent and a step back in time. And we're going to go back to 6th century BC and look at a book written by a Chinese general, Sun Tzu, called The Art of War. We'll look at some of the philosophical statements he had in there. And the most important one is, if you know the enemy and know yourself, you need not fear the result of 100 battles. What he's essentially saying, if you know yourself, you're not going to overextend yourself. You're not going to put yourself into a bad situation where you cannot get out of. But if you do see a good situation, you will act on it. And then if you know your enemy, you know what they're capable of and what they're not capable of. You're not going to get in harm's way from the things they are on the move with. His saying goes on to say, if you know yourself, but not the enemy, for every victory gained, you'll also suffer defeat. It means if you know yourself, but not the market makers, you're going to churn your account. Half the time you'll be right, half the time you'll be wrong. And then if you know neither yourself or your enemy, you're going to lose all the time. Sounds cute, but what's that got to do with you? Well, do you think that, these guys, these market makers, they're bright people. They're smart. And if you look back at this beginning quote up here, know thy enemy, the market maker, who is their enemy? That's you, the retail traders. Your retail traders break down into about 3 different types of traders. If you do a search on Google, you search for trend trading strategies, you get 20,600,000 hits on that. That is a big group of people trying to trend trade. Don't you think the market makers know that? If you look at reversal trading, you get 5,580,000 different hits on how to reverse trade. Breakout trading, you got a 5,030,000 hits on how to do breakout trading. Don't you think the market makers know these things? Don't you think they know your rules that go with those things? And if they know those rules, can't they use them against you? Have you ever even thought of that? Well, what I want to do is I'm going to take you through, to establish a base, I want to take you through the different types of traders that the the trend traders, the breakout traders, the reversal traders. I want to establish their rules. I'm going to do it very quickly. And then we're going to look at it, how those rules work in a day of trading. So to start with, a trend trader just looks for higher highs and higher lows if he wants to go long. He looks for the EMAs to cross over. And then he'll go long when he gets that combination. And he'll put a stop down there. And then they also have trend lines to confirm where they're going like this. And then if they get a bounce off the trend line after they've already established a trend, they'll go long there. They'll put the stop in down there. And then if they put the stop down there too. Then if the stop losses is moved higher as the price moves higher, they get a new high, they can move the stops from down here to up in here. Okay? To go short, they just do the opposite. Now, breakout traders, they look for consolidations, new daily highs or lows, a previous spike in price. It's like this. They get a consolidation, price goes above, they go long. Put the stop down there. Price goes down, they go short. Puts the stop up there. Now, if you get a new high or low of the day, price comes down, goes back up, creating a new high, they go with it. Put the stop right underneath there, or they can put it down below. Same thing with a short. Now, if you get a price exceeds a spike, you get a big spike up in there, the price exceeds it, they go with it. Put the stop down below the last stop, below the last pullback. Same thing for a reversal. No, I'm sorry. Same thing for if you're going short here versus long. All right, now for the reversal trader. Reversal traders, they look for a strong move in one direction, 15 or 20 pips. Then they look for price to reverse and come back. They make entries with trailing stop orders. The stop is usually placed just beyond the recent price extremes, such as like this. If they're looking to go short, they get a little move up in price. They put a sell stop right there. Price goes higher, they move the stop. Price goes higher more, they move the stop again. Comes back down, it triggers them short. They put the stop up high. Okay, and they hope to see that. So they see just the opposite. They're looking for the opposite when it goes long, when they want to go long. And then they also look for another situation. They're looking for an extreme in the RSI, and then an extreme in the price, and then a diversion in the RSI. So like you get a price comes up, RSI is high. Price goes higher, the RSI stays lower. You have a diversion. It goes short in here. They'd be doing the same thing if they were going long over on this side. So those are the basic rules that they follow. And now then, looking at the personalities. The trend trader, they're usually kind of stable if they're rules and they stick with them. Breakout traders and reversal traders, well, they've been stopped out so much they're kind of quirky and they're quick on the gun. So they can take a quick 5 to 10 profit and then they'll move the stop pretty quick. Or you could have some that have a specific price target to hit, or some just go for the gold. So what I'd like to do now is take these rules and apply it to a chart. Okay, now that we have those rules, I'm going to implement them or put them to good use on this chart here. To get you familiar with the chart, what we have looks like a Friday close here with a Monday opening. This blue box here is Asia. We have an 00 line. We have a 75 line, and this blue box over here is what's called the London gap. It's the price action 1 hour before London opens. Down here we have this green line is your RSI. Okay, and the middle dashed line is your 50 line for the RSI. So I'm going to start looking at this as far as what happened from the high of the day. It's just an arbitrary point. I can start from down here or anywhere else, but I'm just going to start from the high of the day because it's the easiest. It's a good point to start, easy point to start from. So what do we see from right in there? As the price came up, we had a high here, a pullback, and then the price went higher. Down here, the RSI was high. The second leg, the RSI was not as high, so we have a diversion and we have a reversal short right in here where the price closed below this EMA. We also have another reversal short when the trader with the trailing sell stop, as he advanced it up, his price went up. He was triggered short right in here too. Now both of these guys have their stop losses right above the high of the day. Okay, so as we come down further in the price action, what happens is we have a breakout trader who went short here as the price went below this spot. We have a breakout trader who went short here where the price went below there. Both of them have their stop losses up here because there's no pullback in the meantime. Now, as the price comes further down and then reverses, we have a reversal trader. The one that is the trailing buy stop gets triggered right in here. As he's triggered long, his stop goes down here. And as price comes up, well, there's no further harm, nothing, no glory. No one is triggered in with a buy, and no stops are hit. However, as price comes back down here, we have a breakout trader who went short here as the price came below it. There are no breakout traders short here because the price didn't go below it. This breakout trader has a stop up in here. These breakout traders here are moving their stop down here because we have a new low, and they move it down to the last pullback. Alright, now then, unfortunately for our little guy who went long there, because his stop was down here, he was taken out. He's our first casualty of the day. Okay, so we're down here at this point, and now then everybody is short, and the price comes back up. It comes up to this point. What happens there is the price exceeded it with a breakout trader who went long. His stop is down here below the last low. Alright, unfortunately, when the price went above here, we had a lot of stops sitting right there. And those stops were all hit. This guy went short here, he's out for a loss. This guy went short here, he's out for a loss. Guy who went short in here, he's a scratch. He made 2 or 3 pips, I call that a scratch. The only ones who made any money are these 2 reversal traders up in here. So our accounting at this point is we have 2 reversals make money, 1 breakout is a scratch, 2 breakouts are losses. Okay, so that's at that point. Now then when price comes back down here, what happens is we have a breakout trader short here. We have another reversal trader who went short in here with his trading sell stop right in here. Both of these guys have their stops right up in here. Okay, now then, unfortunately, as the price came down here, you got a buddy up here. The guy who went long, he stopped out. We have another casualty. Okay, so the price came down, no new triggers as far as over here. Then it came back. No stops were hit, no breakouts were induced. Okay, but I want you to look at the price when it comes down here to this point. Okay, let's see what happens there. Essentially, what happens is I forgot these 2 guys. I forgot as the price goes back up, we have our reversal trader who had his trailing buy stop. He was triggered in here long, and then we also have a diversion over in here. We have a low in the TDI, I'm sorry, the RSI, but we have a higher reading on the RSI, whereas we have a lower reading on the price versus a higher one. We have a diversion in here. So we got the 2 people who went long in here. Okay, their stops down here. Now then, as the price came up here, no harm. But as it came back down to this point, I want you to look at something. Look at what the trend trader saw. He's been sitting on his hands off on the side. He's been wanting to get in, and what he sees is he sees he sees the 13 EMA cross the 50. He sees the 13 crossing the 200 EMA. He also sees the 50 EMA crossing the 200. He sees lows. He sees a high. He sees lower lows. He sees a lower high. He's able to draw a trend line. Price closes below that. Fits all of his criteria for going short. Trend trader goes short right here. Okay? Now then, as the price continues coming down here, what happens? Well, the price came below that, we have a breakout trader short. Price came below Asia, we have a breakout trader short. Now look at this also. I have an AL in there. That stands for algo. The people with the algorithms, look at, you had a spike down, you had a full bar going up, and then you have this engulfing bar that took everything out, and it closed on the low, absolute low of the day, and it didn't have any pins on it. Algorithms go for things like this. It's engulfing and it closed on the extreme. They went short. Okay? All of their stops are right in here. Okay? Unfortunately, when the price came down there, two guys here who went long, they're stopped out in here. Okay, so we have two more losses. Okay, so now then, let's see what a little price action did for us. Price went up to there, and no stop outs, no new inducements. And what are we going to look at? We're going to look at the trend trader who extended this trend line down here. It banged into this. Okay, so we get an extension of the trend. We have another lower high, and the price closed below the EMA. Another good place for the trend trader to go short, especially with the RSI below the 50 line. That means price is going short, right? The bias is short, the trend is short, so you go short. So let's look at what happens on some more price action, and it went up. Oh, I'm sorry, the trend trader, his stop loss was up in here. With the price going up, our traders who were induced long, with the reversal trader in here who went long. I can see I missed another reversal trader who had worked with a divergence because this RSI line is higher than here. The price is lower. We should have had another reversal trader going long. We have a breakout trader who went long when the price went above this pin. A breakout trader went long when the price went above this pin. So these guys are long. But what about all these guys who went short? Remember, they brought their stop loss just above this pin, and we exceeded it. So those guys, all of them are short or stopped out. Okay, what happened here is we have a one reversal who got scratched out because he went short there, but everybody else was a loss. And you know what? I forgot to put in another breakout trader going long there. Oh well, next time maybe. But we have a little price action that came back down in here. So what happened here? Those stops are hit. That's good because we only have longs now anyway. And what happened? We have a reversal trader who had his trailing sell stop in here. He went short. What else do we see right in there? If we have a trend trader, he sees a high in here, a pullback, a higher high, a pullback. He sees a crossing of the EMAs, and he's able to draw a trend line in there, and he sees a close above the EMA. Trend trader is going to go long there. Okay, so what happens next is the price comes above here. When the price comes above here, what do we have? We have a breakout trader who went long there, along with our mystery one that should have gone long above here. Unfortunately, when it comes up here, what do we have? Our little reversal trader who is short is taken out. Okay? So our accounting says we have one more loss in here. Now then, I want you to take a look at what we have right now here as far as what's going on. At this point, all we have is we have the retail traders. We have 6 positions long. We also have a market maker who's got 6 positions short. Because you remember, the retail trader can only go long by buying something from the market maker. For the market maker to sell it, he is going short. Alright? So look at, remember when we talked about this? The situation no longer exists. It's not just you in here. You should look at this as this is what's going on right in here. Right here, this is what's going on. You get the market maker sitting down here. He sold everything. He sold everybody long. Everybody in here is long. Isn't that what we have? What is going to happen to everyone if this guy gets off the seesaw? The bigger question is, what incentive does he have to have the price go any higher? Is he going to make any money? No, he's going to lose. Where is he going to make money? Common sense says price has to go down. Oh my God, look at that. Can you see how the market maker used your rules, the rules of the trend trader, the breakout trader, the reversal trader against them? Look at what we have in here. When you add all these guys in here that were taken out, You add them all up, you have 3 people, 3 trades that made a profit for the day. You had 3 scratches, and you had 17 losses. Yeah, you can say that some people reverse in here and reverse in there, but you know what? You see this price action? See this price action? And then the sudden shot down there? And you see all of this summarized right here? All the traders that would have taken these things have been beat up all day. They have lost their will to trade. They're not going to take that short. They didn't take it short there. They didn't take it short there. Why do you know that? Price just went down there. He wore them out. The market maker knew his opponent. He set him up, then he knocked him out. Didn't give him a chance to get in. That's what he did when he used your rules against you. Now then, let me show you what would happen if you used his techniques with him. Okay, we're going to start from this clean chart, and I'm going to open it up in Paint, and I'm going to mark it up for you. I'm going to show you what the market maker did. Market makers, when they move a market, they move it in 3 pushes. Each push has a different type of what we call a movement. It looks different. Okay, let me show you. Okay, I'm going to start off from the peak, and I'm just going to start counting for you. First push has 3 sub pushes in it. We go 1, 2, and we have 3. This is the first push down. This push down, the type of movement it is, it's an aggressive push 1. Whoops. Okay, an aggressive push 1 does not come back towards the peak. It moves rapidly and far away from it and does not return to it. Now, the characteristics of a push 1 is how push 2 relates to it. Push 2, with an aggressive push 1, does not go very far past push 1, and the pullback of push 2 does not take out the pullback of push 1. Okay, this is the pullback of push 1. So if that's the case, we start counting from here down to here with 3 pushes in it. Now, I don't know if you can see very clearly, but from up at this peak, it came down and went back up again, hitting back up in there. This is a push 1 coming down. I can see it that way, plus I've done over 5,000 setups. I've homeworked that I know that's what it is. I know that, plus let me see here, on push 2 it came down, and push 3 came down. Why I know that is push 1 is because see how push 2 came down and it came right back up in here? It came back and stop hunted the breakout traders of push 1. It didn't want them to, they went short. The market makers didn't want the short people to make anything, so they take them out. This type of movement is a classic. A classic. Let me mark this right here. With a classic, push 1 does not create any breakout trades. Push 2 goes beyond the previous extreme. It creates breakout trades. Push 2 also comes back and stop hunts the breakout traders from push 1, if there were any, or the reversal traders from push 1. And push 3, of course, comes down and extends new lows. Okay, this is a classic movement. Okay, that's the end of our push 2. Now then, the pullback of this, we're going to count 3 pushes in here. Now most of you are probably going to say, oh, I have 1, 2, 3. But that's not it. That's not the count. Let me show you. Okay, I'm going to draw a trend line. You remember the trend trader that we had? He had a trend line that came in here like this. Remember that? Okay, and he was able to go, he went short in here. Okay, what's going on is that you look closely here. You see the price came down and it came back up, a little spike in there, hesitation here, came back up in here. These 2 pins in here, those 2 are what's called a condensed move. They didn't allow a change in the trend. They made it look as though the trend was going to continue down. They didn't establish any new parameters. They didn't make anybody aware that the market had really changed. These are push 1 and push 2. They're a condensed move. Okay. The characteristics of a condensed move are that push 1 and 2 are small. Push 3 is either a vector or 3 dynamic pushes. So from right in here, we've got a little burst right up to that point. We've got a second burst up here, and we have a third burst up here. Let me move that. I'm just going to put it right up there. Okay, that gives us our 3 pushes up for the pullback of push 2. Oh, it's the wrong color. Okay, now then, I have 2 things telling me that this is a great place to take a short in it. One is that we know that this is aggressive push 1, and with an aggressive push 1, the push 2 pullback does not take out the extreme of the push 1 pullback. Price will not go beyond that. Okay. We also know that with a condensed move, oh, I didn't tell you this part. With a condensed move, you get the very small 1 and 2. 3 is a very fast moving thing, and then it reverses just as quickly. See? 1, 2, then 1, 2, 3. Bam! Went up fast, came down just as fast. That's a condensed move. That's the characteristics of a condensed move. And we know this is the best place for going short. I love push 2 pullbacks. They are the best, the most predictable, most profitable part of the movement for you to get into. Okay. So if you went short in here, you have a 5 pip stop. You're like 35 to 40 pips. You would have had a 7 or 8 to 1 return for every dollar risked. It's an excellent place. Okay. So that's what the market maker was doing. Okay, when he was screwing you with all of his movements to try and induce you to go a wrong way and churning your account, this is what he was doing for himself. This is how he did it. This is what he showed. If you knew what he was doing, if you know what he does, this is what he was doing. Okay, and let's put our little 3 in. Oops, where's the thing? Let's put our little 3 in down here so you can, wrong color. Sorry. 3 in down here so you can see that it is 3 pushes down. Alright, so we're going to close this. We'll save it. And we're going to go on to the next part. Coming back to Sun Tzu. Comes down to know the enemy and know yourself. I just showed you something about the enemy. The enemy is the market maker. This is you. We know the market maker knows you. I've showed you that. How he trapped you, how he induced you, and then how he took you out. He churned the hell out of your account, and he took 17 out of, was it 17 out of 20 he won? The question is, do you know him, or do you know yourself?